You're 55 years old and still working. You've got $800,000 in your 401k, and the question is, should you convert any of this money to a Roth IRA? My name is John Vandergriff. I'm one of the owners and lead of the wealth planning team at Blue Ridge Wealth Planners, and so I'm going to be sharing with you a discussion that we have a lot with people that are entering into the retirement phase or the retirement planning phase of life. And so today, as you see here, we're going to be talking about a particular situation, 55-year-old who has $800,000 in their 401k that is still working and contemplating whether now is a good time to start taking distributions on this money, paying taxes, and we're going to look at what maybe some issues with that, but also some benefits of making that type of decision. So as we look at this, for us, tax planning is important, but it is a part of a much bigger conversation. It is one of the 5 main areas that we cover in what we call Plan for Everything for retirement. So as you see here, income, investments, taxes, healthcare, family, legacy, all those things are going to fit together individually based on the particular client or family's needs or wants for those retirement years. So as you see, we're going to focus a lot on taxes. We will, in doing that, look a lot at income. But what I want you to see is the overlap here and how just focusing on taxes is not enough to build out a full retirement plan. We're going to look at the things that go into this particular discussion, but as we start off, I always like to say anything that we cover information-wise, do not take this by itself and make the decisions that you need to. A lot of times we're going to work in conjunction with our client CPAs or tax preparers, making sure that we're all on the same page, understanding all the information. So with that being said, we're going to look at some hypothetical situations today and make sure that we cover our bases in this particular situation. So we've got a married couple, age 55 and 53. They have today $100,000 of combined income, and so we'll look at what that does from a tax perspective. We've got $800,000 in 401ks. They are looking to work another 10 years. So again, they're not retiring today, but they're starting that planning process like a lot of people do. And when they get to Social Security at their age 65 and 63, they would have about $4,100 of income coming from Social Security. And so they target that their income need at their retirement years will be $8,000 a month, or as you see, $96,000 a year. So as we look at this, these are important things to factor in whenever we look at this type of decision of does a Roth conversion make sense, because we need to know obviously how much money is in tax deferred accounts, but also how much income you have today versus what you think that income need will be later. And again, projecting 10 years into the future, inflation could be one of those things that we've got to factor in and maybe increase that need a little bit, but we're just looking at these numbers today. So when we look at this, we've got to factor in some things that are a little different when we talk about Roth conversions for people under the age of 59 and a half, because most people know that age, because if you pull money out of a 401k or IRA type of account, you will have a penalty if you take that money out. And so that is true, but we also need to factor in the things that are specific to Roth conversions that we need to weigh in this decision making. So the first is, if you convert dollars under the age of 59 and a half, you will actually have to wait 5 years from that point to withdraw any money off of that. Otherwise, you would face the 10% penalty that you would have gotten for doing the Roth conversion before your age 59 and a half. So that's not just limited to the growth potential, but it's limited to the principal in there as well. So in this particular situation, since this family is working another 10 years, that is not necessarily a negative for them from a planning perspective, because they hopefully will not need this money in the next 5 years. But the bigger thing that we're going to focus in on today is the second part, any dollars withheld for taxes from this money, because you can either pay the taxes yourself, either by estimated quarterly payments or pay them whenever you get to tax time. But most people don't have large amounts of after-tax money, and so if you don't, most of the time you can take a tax withholding from an IRA or 401k account. If you did that though under the age of 59 and a half, any of that tax withholding would count as a penalty distribution, even though it's not coming to you, it's going to the government, it's leaving that account before the age of 59 and a half. So we need to factor that in and make sure that we've got the right situation going on here when it comes to the things that you have going on. So as we look at this, one of the questions that we get a lot is, why do we even want to consider doing a Roth conversion? And so this is an example where I'm going to use round numbers. It's not going to be the exact numbers here, but the thing that we are trying to find, and really the only thing that matters in this discussion, is when can you pay the lowest percentage tax? That is what we're after. That's what we're trying to find for all the people that we have discussions with. And as you'll see in this example, that is truly the only thing that matters when we look at this. So for round number's sake, let's say you've got $100,000 in a 401k or IRA now. And so what we're looking at is, does it make sense to continue down this path as a 401k, or to make the conversion of this money to a Roth, either IRA or 401k? So if we do this, and again, I'm going to talk about, this in tax withholding terms, just so it's an even example. If you take that $100,000 and move it to the Roth, it's going to be different than if you leave it alone, because the 401k will have no taxes owed. So again, at the time that you do this, because obviously you've not taken any money out, so it will continue to grow tax deferred. So you still have a $100,000 balance. The Roth, whenever you do this, you move this into a taxable event, and whenever that happens, there will be a percentage owed for taxes. So let's say it triggered a 20% tax when you made this conversion. And again, for our purposes in this example, we're going to assume you're over 59 and a half, so you can take this 20% without a penalty. And so you would have a net $80,000 in the Roth account, because the other 20 went to pay your taxes for the conversion. So sometimes financial advisors will start to push back here whenever we share this example, and they'll say this is a bad deal for clients because the 401k has more money than the Roth. If it has more money, it's going to grow faster, which again, from a math perspective is true, but we're not looking at a side-by-side apples for apples comparison yet. So again, we're going to double the value here, and when we do that, that's going to take care of inflation, time value money. We're just assuming that all the metrics are the same, because what we're looking at here is what truly matters in this example, which is the taxes. So again, you invest these accounts to where they double in value. You've got $200,000 in the 401k, $160,000 in the Roth. As we know, if this account's been open for longer than 5 years, not only is your principal contribution, but your growth is now coming out tax-free. So we know with this Roth, whatever its account balance is truly the balance of that account. The 401k, it depends on what the taxes are at the time. So what's ironic is if the taxes were the same when you went to take this money out as they were when you started, it actually did not matter which decision you made, whether you converted to an IRA or a Roth or not. Even though this is growing tax-free, you still have the same account balance in both situations. Now, generally speaking, when you look at the way that most people plan for retirement, they say, oh, well, your income is going to go down in retirement. Income going down in retirement would mean less taxes. And if that was true for you, it would actually be a bad thing for you to do a Roth conversion today, because if your income taxes went from 20% like they are now to 10%, you'd actually have more money leaving it alone in the 401k as opposed to putting it into a Roth, even though it's growing tax-free. And so as we look at this, the real issue that we have today is the overspending that's happening in Washington, the large amount of debt that we have in our country, and as a result, I think there is very low chance, I can't guarantee, but a very low chance that income taxes will go lower on an equivalent dollar. So that's the risk that we're trying to identify for the families that we talk to. And so if income taxes went up to 30%, you don't have 180 here, you've got 140, which means now would be a good time to start paying those taxes. So again, this is one of the things that we look at is just when can we get the lowest chance. If we can pay lower taxes now than we can later, a Roth makes sense. If we can pay lower taxes later than we can now, a Roth does not make sense, okay? So that's what we're trying to find in this example, but there are some other factors that we need to consider when we look at these examples. And the big question for this family, who again are age 55 and 53, is how much after-tax money do they have? Because we do not want people going into a penalty situation, because that's immediately going to add a 10% tax effectively on whatever money has to be coming out for a tax withholding. So really we want to be playing with after-tax money in this particular situation for a family that's under 59 and a half and also still working and not able to get to the money in their 401k. All right, so if we go back to our planning page here, what we're going to look at is two different situations, one where there is a smaller amount of after-tax money, the other where there is a more impactful after-tax amount, and see how that affects the decision of Roth conversion. So what we're looking at here is the $100,000 of income that they have based on where the tax brackets are today. That would put them into the top tax rate being at 12%. And so again, we know our pre-tax amounts are $800,000, but in this, we only have $50,000 of after-tax money. And for this particular family, that money is in their bank accounts, checking and savings. And so for this, I don't like to see that account balance get much lower than where that is, especially if that's the only after-tax money that they have in case of emergencies. So in this particular situation, what I would recommend is going into not doing a Roth conversion using that bank money unless they are either able to build after-tax savings from maybe paying off a mortgage, saving a little bit more diligently on a monthly or bi-weekly paycheck, however they get paid, or they could see if there's a Roth 401k option at their work and be able to contribute those dollars and pay the taxes as they put it in instead of doing large conversions at one particular time. So unless you've got a larger amount of after-tax money, I would say waiting on the Roth conversion until maybe 59 and a half could make sense, obviously depending on the tax situation. Now, what we're going to look at here is a different scenario. All of the factors are the same: $100,000 of income, 12% top rate, $800,000 in the 401k is the same, except now, instead of $50,000 after tax, they have $450,000, which is more than they need to pay any taxes, even if they converted the entire $800,000. The maximum income tax bracket this year is 37%, so this is more than they would need for that. So with the after-tax monies not in question here, we're just trying to look at, is now a good time to do that? So obviously we have to look at where the tax brackets have been in the past so that we can decide if, going back to our example, is now the time to pay the least amount of tax versus sometime in the future. And so obviously we don't know the future. If we did, we not only help people with taxes, but stock picks and things like that. But we do know where we're at today, and we do know what will change if certain things occur in our society. So this is the 2022 tax brackets with standard deductions included. So again, as you see, $100,000 of income would top out at the 12% bracket. 2017, these brackets are relevant because the current tax code, if it did expire, would go back to these brackets, obviously adjusted for inflation like we have done here. So that $100,000 of income would start or top out at the 15 and really be very close to the 25%. And then 1981 tax brackets, the reason we bring this up, this is the last time that we had a significant tax increase from what we've really been existing in the last 3 decades. So if this family was at $96,000 of need, their top tax dollar would be in the 28% bracket versus the 32. So as we look at this, starting distribution, which is where those incomes would start at, because this family, once they get to retirement, would have a little over $4,000 of Social Security income, so that would be at 12% in the way that the brackets are today, versus if they waited and didn't take any money out, 15% would be obviously higher than 12, and then 21% would be higher than both of those figures. I think reality may be between these numbers. Like we said, we don't know what the future holds yet, so that's something that we have to weigh into the recommendations that we make. So in this particular situation, if we look to convert, again, they were kind of on the top of that 15 to 25% if things went back to 2017. So I think because they have a large amount of after-tax savings, going ahead and maxing out that 12% bracket would make a lot of sense. And then if they wanted to max out the 22% bracket, they would be able to convert another $94,600. So their total amount of conversion would be $104,000. The effective tax rate on conversion there would be 21.1%. So, a little over $20,000 it would cost them from a tax perspective. But this $104,000 would now be able to move into a Roth position, start growing tax-free and yielding tax-free benefits when this family did retire 10 years later. So as we look at this, obviously we've got some things that we would have to weigh in the individual recommendations that we would make here. So, if you have not been able to have a discussion like this, we would be happy to share that with you, see if this type of conversion can make sense for you, plug in your numbers and really see where we're at today versus where things could be in the future. So if you look, make sure that you click the link below. Also, if you like this content, what I would say is subscribe to our channel, share it with other people so that we can continue to get this message of tax planning out there and help as many people as we can in the process. Hope you enjoyed our time today. That's all we have for this edition of our conversation. We'll look to see what makes sense to convert in the future. Look forward to talking to you then.